Hello, everyone. Logan Hertz back here again with Hazeltine LLC. We are on to part two, answering some of these objections to infinite banking that come up in this article. I have with me, as always, Peter Nelson of Nelson Insurance Advisors. Peter, how you doing?
Living the dream, Logan, living the dream.
Okay, so we're going to kind of continue on where we left. And in the section that we're talking about, it's titled Infinite Banking's Rate of Return Sucks. So we know that's not a very professional person. But again, rate of return is not the relevant metric. The problem is always people's preconceived notions. It's not so much their logic. If you think rate of return is a relevant metric, then in my opinion, you're not going to judge any financial product correctly because there is no more useless and irrelevant metric than return on investment. Wall Street has propagandized us into thinking that's the end all be all. Because if they're going to get us to lock our money up in their jail, okay, they have to give us something in return. And it can't be anything real, right? So what they give us is that they can now advertise a larger number on the page on your statement. We call it statement wealth. And statement wealth is in many ways fantasy, right? You might see a big number advertised on your IRA, but how much of that money is actually yours? Like how much can you actually get access to, right?
Right.
So really what it is, it's a way of psychologically manipulating you into keeping all your money parked with them. Because as long as you keep it parked in their jail, then maybe they can advertise that you have $1 million. But as soon as you try and get it out, all of a sudden taxes, penalties, fees, whatever else, right? So you don't really have $1 million, right? So again, it's the 4 rules of financial institutions. Rule 1, give us your money. Rule 2, let us keep it for, rule 2, give it to us on an ongoing systematic basis. Rule 3, let us keep it for as long as possible. And rule 4, if and when we give it back to you, we're going to give it back to you as slowly as possible. And if you follow this return on investment metric, you're going to be easily sucked into that form of manipulation. Okay. So it's not an investment vehicle. Whole life insurance and infinite banking, not an investment vehicle, not an investment strategy. So why are we talking about return on investment in the first place? Right? We've established this is not an investment vehicle. Okay. Let me ask you a question, Peter. The last time you made a major purchase, what was your return on investment?
Like, what am I buying?
A car. Let's say you bought a car.
I didn't make anything on that car. I lost probably 20% the minute I drove it off the lot.
Exactly. Exactly. So if we can get you any of that money that you're going to spend anyway back, you're coming out ahead, right? It's not that you're getting a 3% return on investment where you take your money, lock it up in jail, and it grows at 3%. No, what's happening is you're taking money you're going to spend anyway. Okay. And you're flowing it through your private bank, especially Zion Whole Life Insurance, and financing the purchase that way so that you get a compound 3% return on money that would have permanently left your personal economy. So no matter what the number is, 1%, 2%, 5%, it's all gravy. Okay. Another good analogy I think that works with people is a rewards earning credit card. Okay. Take money you're going to spend anyway and put it on a credit card that gives you 2% back. Now, if I advised you to do that, I hope you wouldn't come back and say, well, 2%, that's a terrible return on investment. That's terrible. Dave Ramsey tells me I can get 12% on mutual funds. And it's like, this is not an investment strategy. It's a financing strategy. I'm not telling you take your money, lock it up in jail and park it there and watch it grow at 2% per year. I'm saying take money you're going to spend anyway, run it through a rewards earning credit card. So now you get 2% back. You haven't changed anything you're doing. You're just running your expenses through a more efficient vehicle that gives you extra benefits. Infinite banking works the same way. Replace your checking account that gives you no benefits, no return on investment, nothing. It's just a pass through with specially designed whole life insurance. So now you can earn on every single dollar that flows through your personal economy, including the dollars you spend. Okay. So whatever return on investment you're getting, it's all gravy because it's on top of whatever you're already doing. You're not parking your money in jail. You're running your money through a more efficient cash flow management tool, right?
Sounds good to me.
So that's why this whole argument over return on investment just shows that these people do not understand anything about not only infinite banking and whole life insurance, but how finances work in general, right? Ask any rich person how they got rich. They're never going to say, well, I got a great return on my investment. No. As Robert Kiyosaki says, it's not about return on investment. It's about cash flow. Okay. Now, that's not to say return on investment is a completely irrelevant metric. I mean, it is a thing you can measure and it could factor in, but okay, whether you get a 5 or 6% rate of return on your savings, not going to make a massive difference. Okay. The other thing I wanted to point out, he jumps into this, talking about how you take a loss in the first 2 years. We talked about why that's not true. Okay. But the better way to think about it is the way that Chris Kirkpatrick is showing. I'm assuming the way he talks about it in this video, which is not in terms of return on investment or in terms of cash in versus cash out. It's in terms of cash flow, right? So if I can give you, Peter, a magic bank account where every dollar you deposit into the bank account results in, let's say, $1.05 of account balance growth. And every year after that gets better, where the next year it's $1.08, and then it's $1.15, right? And when you use the money that's in this magic bank account, it keeps earning for you. It doesn't stop earning, right? Sound like a good deal?
Yeah, absolutely.
And we're comparing it to the right thing. We're not comparing it to an investment. We're not comparing it to a sinking fund. We're comparing it to a bank account. Okay. So if I could give you that, that would be too good to be true, right? That'd be giving you something for free, which this guy can do, but I can't do. This guy says he can give you something for free, but I cannot. So sorry, I can't give you a free lunch. If you want something for nothing, this guy can give it to you, but I cannot. So it's not too good to be true, but it is too good to be free. So the snag is, Peter, you have to pay me an upfront fee to set up this bank for you. And you have to wait a couple of years for this bank to reach the efficiency I'm talking about, right? That's the trade-off. That sounds like a great deal to me.
Sounds like a long-term savings account to me.
Yeah, and I'd be willing to pay a pretty substantial amount of money and wait a few years to have that. Because once you have the bank account up and running, it's great. And by the way, this is the way everything works. If you start a business, if you invest in real estate, right, it's going to take you some time to get cash flow positive. That's just the way anything works. There's always a cost, right? There's some trade-off. There's some initial investment. There's some loss of liquidity. Otherwise, it's too good to be true. Okay. So you can see here what the better way to look at this is the way Chris is looking at it, which is to say, again, in year 2, you pay in a $20,000 premium and your cash value grows by $22,000. So you already have your magic bank account where every dollar you deposit results in more than $1 in cash value growth. And you can use the cash value that's in there while it keeps earning for you. That's a phenomenal deal. What's the trade-off? Well, it's this loss of liquidity in year 1. So in year 1, you paid in $200,000 and you only have $185,000 in cash value. So the way I view that is you paid a $15,000 upfront fee and you had to wait 2 years, and now you have your magic bank account.
But you do have it.
That sounds like a great deal to me.
Sounds like a better deal when I see a $2.9 million death benefit with critical and chronic illness, knowing that this is actually a Lafayette policy.
Yeah, I just want to say that when I dig into this, I have the opposite response to these people. My response is, this is way too good to be true. Like, this can't possibly be true. These numbers must be wrong, right? Any infinite banking guy like me, someone who really understands this, the more you dig into it, you have the opposite reaction. You're like, why isn't everyone plowing as much money as they possibly can through these vehicles? Notice I didn't say into, I said through. You're not parking your money in jail. You're freeing it up, okay? You got to get out of this return on investment mantra where we think the only way to grow our wealth is to lock it in somebody else's jail and hope it goes up. That's not going to get you anywhere.
Well, thank goodness everyone doesn't realize that. We'd be without jobs. People would be lining up to buy this stuff, right?
That's right. Yeah. Yeah. They'd have robots selling it. Yep. Yep. So, and then the other important caveat too is the size of your bank account, as you would expect, is relative to the size of the upfront price you're willing to pay in the number of years you're willing to wait, right? So if you want the ability to stuff more cash, run more of your cash flow through this awesome bank account, right? You have to be willing to pay a larger upfront fee, meaning accepting a lower loss of liquidity, right? And you have to maybe wait a few more years to really get it going, right? If you want to build larger and the stronger the financial structure you want to build, the larger and stronger the foundation you need to build, right? And when the foundation is being built, it's super important, but you're not going to see a lot of above ground progress while you're doing that. But that's the way anything works. That's the way anything works. You can't get something for nothing, right? And the other great thing about whole life insurance is there's so many psychological benefits to it. It instills in you the right way of thinking, the right discipline, the long range thinking. And the other thing that's really hard to show is how having whole life insurance in your financial structure makes everything else so much better. It improves every other aspect to your life.
I think,
And then to close off this whole thing, that upfront fee that I talked about, you're guaranteed to get it back because of that permanent leverage death benefit. So it's really only a temporary loss of liquidity. It's not even a cost in the long term, right? You will get that back in spades at some point in the future, either through the cash value growth or through the death benefit.
yeah.
Okay.
You'll either get it back while you're alive, or your family, business, or charity will get it when you die. One or the other.
Yeah. In my opinion, this is too good to be true the way I view it. I have the opposite reaction. I'm like, it can't be this good. These numbers can't be right, until you have to dig in and understand actuarial math. Yeah, this math is really powerful once you get math working in your favor.
I'm stunned that he's actually picking on the cash value, looks like after year 10 here. Or
Yeah.
is that no, that's Chris just pointing out.
No, I think that's this guy. I think this guy added those arrows. I don't think it's Chris.
Because that's
No.
the part where I'm excited, because right there, your cash value is positive at year 10 right there. And now look at the way it's growing, right?
Right. The problem is people are so locked into this false return on investment paradigm that when they look in a whole life insurance contract, they don't understand what they're seeing. And so they look at, how long does it take for me to get cash on cash return where the amount of cash value of my policy is equal to the amount I've paid in, right? Okay. And then what return on investment am I getting? Okay. That's the wrong way of viewing these things. That's, in my opinion, the wrong way of viewing anything. It's about cash flow. It's all about cash flow. When you look at your personal economy and try to figure out how you're doing, you don't ask yourself, what return on investment did I get this month? No. How much money do I have coming in and how much money do I have going out? We need to start thinking about our personal economy more like a business. Okay. It's about cash flow. It's all about cash flow. The more I can eliminate or reduce the amount of money leaving my personal economy, and the more I can increase the amount of money entering my economy, the better off I am. And the great thing about the infinite banking concept is we improve both of those ratios without changing anything you're doing. You don't have to get a new job or get a raise or get a bonus. You don't have to cut back on your lifestyle. You don't have to do any of that. You're just optimizing what you already have, making the most optimal use of what you already have by running your cash flow through a much more efficient vehicle, specially designed whole life insurance, rather than a standard checking account, which gives you no benefits other than convenience. Okay, here we go again. All right. I'm cringing a little bit as I read this.
All right.
Infinite banking's rate of return sucks, part 2. So once again, I don't know that we're dealing with a professional here. But anyway. Now we turn to the longer term rate of return with infinite banking. Okay, let me stop there. If you're talking about infinite banking, rate of return is not a relevant metric. Okay, there is no rate of return with infinite banking. It's about cash flow efficiency. It's about a financing strategy. Rate of return does not enter into it. So once again, he doesn't know what he's looking at. He thinks he's looking at an investment, right? No. All right. Before we reveal the true long-term rate of return in the whole life policy projection of a promoter of infinite banking, now let me stop there. He just contradicted himself, and he doesn't even realize it. First, he says the rate of return with infinite banking. Now he's talking about the rate of return in the whole life policy projection. Those are two different things, right? We're not showing you using this policy to finance purchases. We're just showing you the vanilla policy illustration, right? So he's not making the distinction between the infinite banking concept and whole life insurance, right? This illustration does not show us making use of policy loans in the whole life insurance policy, right?
Right.
If you look at your financial picture and you're just looking at your checking account and that's it, you're getting a very narrow view of what your financial picture looks like. It's the same thing here. If you're looking at just this whole life insurance policy illustration, it's like looking at your total financial picture and just narrowing it down to your checking account. Well, that's not giving you the full picture, right? Okay. And once again, he says a promoter of infinite banking. Well, Chris Kirkpatrick is not a promoter of infinite banking, and this video is decidedly not promoting infinite
Which
banking.
it
It's kind of
says right
cautioning you against it.
if you look in the little title right here, right? What does it say?
Don't stop funding your infinite banking policy too soon. That's what it says. And I agree with Chris on this. This is something this guy who's writing this article probably doesn't understand.
But wasn't the video before that was totally like, it was totally.
Yeah. Yep. Here's the one before. It's the same video. It's just different parts where he says,
no, this one.
infinite banking will not get you rich by appreciating.
That's the one I was referring to. Anyways.
In the title of the video, he did link it at the bottom. The title of the video is 5 Mistakes People Make with Infinite Banking. It's not like, ooh, infinite banking is the coolest thing since sliced bread. Check this out. No, he's cautioning you against it. Okay. So he's not exactly a promoter of infinite banking, is he? Okay.
That's, I'm still amazed that he's, anyways.
Plus, all this focus on rate of return ignores all the intangible benefits you get from whole life insurance and infinite banking, like having control. Having control. Even if it were about rate of return, I will happily accept a lower return if I get control over my capital.
Look, it's right? the only reason they always do this. Why do they do this compared to an investment? Because it's the only way they can really, tear it apart.
Right. To your point, Peter, he's not explicitly comparing it to an investment, but he is implicitly, because he's trying to measure return on investment. Well, wait a minute, this is not an investment.
Right.
And there are lots of different ways we could use whole life insurance, right?
Right.
I might structure a policy that deliberately that gets a terrible return on investment because let's say we're doing it for estate planning purposes, right? Or other reasons, okay? So again, it's like real estate. You can't look at a piece of real estate in isolation and say it's a piece of trash if you first don't understand what we're trying to use the real estate for. Depending on your use case, it could be great or it could be terrible, right?
Yeah.
But if you compare it to an investment, Peter, it always looks bad. And of course, the returns they project out in their investments are total fantasy. You can tell me you're going to get a 12% return, but you can't prove any of that. So you're not even making an argument. You're just making an assumption in place of an argument. Well, I'm just going to assume I get 12%. Yeah. Well, that's not an argument. That's just an assumption. Whereas here we have guarantees. So these numbers are actually much more meaningful, right?
Right. He's living in Disneyland like all of them. And hey, you can do that. It's just
advertising. Yeah. The number you get on your statement is advertising. The returns they project out, it's advertising. It's not based on science. It's advertising. Just like when you see Walmart advertising their products. They're not lying to you, but it is advertising. So take it with a grain of salt. Same thing. When they project out these wonderful returns, right, or however they calculate them, understand that is an advertisement for whatever vehicle they're trying to sell you, okay? They're not necessarily lying to you, but the information they're choosing is selective, and the assumptions they're making are, I would say, unrealistic.
Yeah, and I'm guessing, I don't see anywhere where this guy's referencing the Ernst & Young report.
Mm-hmm.
If
no, he'd rather engage in name calling and moral posturing. You get more attention that way.
Isn't this the wealthy accountant or whatever he called himself?
Yeah.
And yet, isn't Ernst & Young one of the top 10 largest accounting firms on this planet? Mm-hmm. And they actually say you got to have cash value life insurance in a portfolio, but this guy's saying it sucks.
Mm-hmm.
How can that be?
I mean, and Ernst & Young, I don't think they really focus too much on return on investment, right?
No.
Because especially when, really all throughout life, but especially once you get to retirement, it's about income. How much income are you able to generate, right?
Yeah.
That's where, like I talked about in another video, having $1 million in, let's say, a retirement account versus having $1 million in cash value in a seasoned whole life policy is not at all the same thing. You can get way more income safely, tax-free, out of the whole life policy than you can out of the retirement account, right? Just because the numbers on the page are the same doesn't mean it's providing the same amount of value. It is not.
Especially if we have more volatility in the future. And I ask that question all the time. Do you think there's going to be more or less volatility going forward? And everybody says more. Do you see that's what makes, these types of strategies so amazing? And they're like, what are you talking about? Well, if you could be guaranteed to never lose any money and still have complete access to that money, doesn't that mean you can take advantage of all the bad stuff when it happens? Oh my gosh. And they're like, you can do that? And all of a sudden a light bulb goes off, right?
Mm-hmm. Yeah. What if you had like $100,000 in a cash value policy in the depths of COVID, where you could have pretty much closed your eyes and pointed to almost any stock or asset and bought it,
Oh
and
my
probably
gosh,
doubled your money in a year?
Oh my gosh, March of 2020. Could you imagine if you would have bought any oil companies? Remember, oil went negative.
Mm-hmm. Mm-hmm.
And I kicked myself for that one. Man.
Yeah, ExxonMobil was paying effectively like a 14% dividend or something crazy because their price had crashed so much. Like, this is a blue chip stock. This is not some speculative stock, right?
We will never see that with oil ever again. That was just one of those.
Yeah, who could have predicted the price of oil would go negative?
Negative.
Right.
Negative.
But yet these guys can confidently project out 12% returns for like 30 years, right?
Yeah.
As if they know the future.
Yeah, and the government can just keep on magically printing money like it's going out of style, right? Because that's
Taxes won't go up. Don't worry about that.
No.
Okay. We don't have to make any of those assumptions in Poland. All right.
No. Just keep on putting into the market. The government's just going to keep on printing the money. It's going to keep on going up. That's what happens. I mean, hey.
Okay, so before we reveal the true long-term rate of return in the whole life policy projection of a promoter of infinite banking, let's ponder the idea of tying so much money up in what the video is described as a savings account. You're not tying your money up. That's what one of the huge things he's missing here. He acts like you're tying money up. No, you're not. You can borrow against this policy anytime you want with no repayment terms. You are freeing up liquidity. You're not tying up your money. So again, he's myopically focused on this return on investment mantra. So his faulty assumption is that when you put money in a whole life insurance policy, you're tying up your money. You are not.
Unless you're Northwestern Mutual. Sorry, bad joke. Bad joke. Sorry. I love the cult.
Okay. The whole, pun intended, premise of infinite banking is to have an ever-growing pile of money in a low-yield savings account. The only way to turn this into a win is to use faulty math. So again, he's, whether knowingly or unknowingly, he's mischaracterizing infinite banking. He says, so now he's first he says infinite banking is a twist on the sinking fund. Okay, now he's changing the definition already. I don't know whether he realizes this or not. Now he says the premise of infinite banking is to have an ever-growing pile of money in a low-yield savings account. No, that's not the premise of infinite banking. That's your caricature of it. No.
And for a second, does he mention anywhere about tax equivalent yield there?
Right. This would be a tax-free, growing tax-free, right? With guarantees. Remember, there was a time where your standard savings account was paying you 0.1%.
Yeah. 0.0, yeah.
Meanwhile, you were earning a huge amount higher in whole life, right?
Yeah, 0.08% was, yeah. I think there was actually 1 month, I want to say it was December of 2019, where I saw that a 1-year treasury or something like that was, or the average money market was literally not paying anything. Like, it was crazy.
And he's about to jump into numbers.
2009, I'm sorry, December 2009, not 19.
Yeah. And he's about to do what a lot of people do, is jumping into the numbers, where the problem is you've already set up the wrong premises. You're looking at the wrong numbers. You're analyzing it the wrong way. So your numbers may be internally consistent, but you're missing the whole point because you're, again, focused on return on investment. I don't care what the return on investment is. That's missing the point. You have never heard me say you should put money into a whole life insurance contract because you'll get a great return on investment. I've never said that. I've never heard any life insurance agent say that. It's only people who attack life insurance who say that you'll get a bad return on investment, right? Because they're missing the point.
Because they can't beat it any other way. And I always say to people, look, I completely understand. I hear that all the time, but you realize that that's actually demeaning the cash value life insurance. That's the only way they can beat it, because it can do all these other amazing things. You know, they can't beat it any other way. So they pull out the how to trash cash value life insurance. Okay, compare it to an investment. Option 2, compare it to an investment. Option 3, compare it to an investment. It's like, can't you guys get more creative? Or the other one, right, is oh, it's a ripoff because you can't have the cash value and the death benefit. You know, we've talked about that before. That's the other one that one absolutely kills me. Right?
Yep. Okay, now here we're going to get into some numbers. I'll try to stay out of the weeds on this because, again, the whole premise is irrelevant. So these numbers don't mean anything. Okay, they may be internally consistent. They may be correct as far as they go, but they're completely missing the point, right? But this is how he can appear to be scientific. And I think he thinks he is being scientific, but the problem is not his numbers. The problem is the premises, the preconceived notions behind the numbers. That's the problem. But first, review the future value calculator below. You can use a variety of other calculators to get the same results. Okay, so he's going into this. He's looking at the $200,000 initially, and then 20,000, blah, blah, blah. So he's trying to show what it would look like. Okay, blah, blah, blah. After 10 years, you manage a bit more than a 2% annual rate of return. Again, irrelevant. That's not the right way to view it, but okay.
Can I see this at year? Can I see it at year 30?
Yeah. But my question, again, this 2% annual rate of return. Okay. What he thinks that means is you lock your money up in jail and it grows at 2%. That's what he thinks that means. That's not what it means when you're talking about infinite banking. What this means is you are now earning a 2% tax-free, risk-free compounded return on every single dollar that flows through your personal economy, including the money that you spend. This is on top of whatever you're already doing. We're not telling you to park any money up in jail. We're telling you to run your money through a more efficient vehicle. Okay. So again, it's like saying, well, if you use a rewards earning credit card and you get 2% cash back on all your purchases, well, 2% is a horrible rate of return. Well, no, this is not an investment strategy. It's a financing strategy. It's a cash flow management strategy. So once you understand what that 2% number actually means, you understand it's phenomenal and it's all gravy. You're not locking any of your money up in jail. You're not doing anything differently from what you're doing today. You're just running your money through a more efficient cash flow management tool and getting a whole host of benefits as a result. So he doesn't know what that number means. So a 2% rate of return, once you contextualize it, is actually awesome with this, right? Okay. Of course, the infinite banking cheerleaders will have you believe you can borrow out your own money and invest it in other income-producing investments. The idea is to get you to believe you can earn money on the money borrowed from your infinite banking account while simultaneously collecting a profit on other investments with the same money, which leads us to the next fatal flaw. Okay, first of all, you can borrow out, quote unquote, your own money. Like we've said, it's the insurance company's money, not yours. You collateralize your cash value, but you're borrowing other people's money, not your own, which is the whole point. And yes, you can simultaneously earn on the cash value that's in your policy while whatever you invest in keeps earning too. So you can earn in two places at once. Yes, you can. Okay. Infinite banking loans are not what you think. Okay. When you take out a loan from your whole life policy, what really happened? First, the cash value is a contractual promise. The money is really in the general fund of the insurance company. We will discuss this important point in greater detail below in the last fatal flaw. We will discuss on infinite banking before turning to two alternatives that actually work. Okay, let me stop there for a second. This is actually important. It says the money is really in the general fund of the insurance company. Okay. The question is, as compared to what? As compared to what? So we talk about the cash value, okay? As compared to what? Money in a bank account is not your money. When you deposit money into a bank account, you have not made a deposit. You have made an interest-free unsecured loan to the bank. It becomes the bank's money, not yours, and you are an unsecured creditor of the bank. So to point out that the cash value technically doesn't belong to you makes it no different from anything else in the financial sector. One of the big problems we have is in our society is an ownership problem. This is why the element of control in infinite banking is so important. You're regaining control of your capital. Okay. Money you have in a bank account is not yours. It belongs to the bank. All those stocks, bonds, and mutual funds you have in a brokerage account, they're not yours either. They're held in what's called street name, which means your broker, your custodian, they actually own it, not you. And if you want to test me on this, call up your broker, call up your custodian, Fidelity, whoever it is, and say, please send me my share certificates. Please send me the legal proof that I own these shares. They will not be able to produce it. Okay. When you buy a car, you get a title. When you buy a house, you get a title, right? When you put your money in a bank account, when you put your money in mutual funds, you get nothing. It's just statement wealth, which is insecure at best. Okay. So I think it was Nathan Rothschild who once said, own nothing, but control everything, right? If you have control over an asset, contractually guaranteed, you effectively own it. And that's exactly what you have with cash value in a life insurance contract. It's actually the best of both worlds, because with ownership does come a certain degree of liability, responsibility, etc., right? If you actually wanted to own your own cash legally, the only way you could really do it probably is just have physical cash in your basement, right? And now you have to take care of it. You have to custody it yourself, right? It would be better to have cash value in a life insurance contract where you have contractually guaranteed rights over it. So you effectively own it. And the fact that the insurance company is holding it for you is a benefit. That's what they do for a living. They protect your capital. They keep it earning for you, and they've kept it earning for you through the Great Depression, through World War II, through World War I, right? I mean, through the stagflation of the 70s, through all these periods of economic crisis, they kept paying out dividends. Okay, so why would you not want your safe money there? Yeah. So the cash value is yours in a way that money in a bank account is not. You have contractually guaranteed rights over it. So that's really important. So you actually have control over your capital, unlike money in a bank account or money in a brokerage account, which is not yours.
Yeah. And they, by the way, insurance companies are some of the biggest investment managers out there. So when people don't really think that insurance companies are investment managers or manage a lot of money, they literally manage billions of dollars.
Yeah. Yeah.
Some of the biggest bondholders, by the way, are insurance companies.
Yeah, and one of the best things about these life insurance companies is they can invest with a long term perspective, which is why they're able to be so stable, right?
Right, absolutely.
When they make investments, they're thinking in terms of multiple decades,
yeah.
Right? Most businesses can't afford to do that. They can.
Yeah, Wall Street's not thinking about 100 years later. They're thinking about when they could buy their next yacht tomorrow, right?
Right. Right. So again, it's what he's not saying. It's the implications that are a problem. Because the implication is, well, there's somewhere else where you actually can have your money under your control. Well, show me that. I've never seen it. Not a bank account. The money in your bank account's not yours. The money in your brokerage account's not yours, right?
Yeah. And
so the cash value is yours in a way that those are not.
Yeah, and let's face it, aren't all the banks in a way nationalized? I mean, think about it. The government controls them. I mean, March of 2020 is the finest example. When the Corona crash happened, ladies and gentlemen, every bank was immediately in a cash crunch. And the government bailed out pretty much every single bank in this country. Okay.
Yeah, you should watch my video. I'll put it in the description called How Much Money Do You Have in the Bank? It explains a little more about how this works, right? But because of the fractional reserve banking system, the banks are by definition insolvent. They do not have the reserves to back the amount of so-called deposits, i.e. loans that they have. So if everyone came to the bank and wanted what they thought was their money, try to withdraw it, we'd have a bank run, okay? Whereas the whole life insurance companies operate more like real banks in that they have more than 100% reserves. If everyone came to the insurance companies all at the same time demanding their cash value, they could easily service it. There'd be no problem. There'd be no bank run because they actually have the money. They actually have the capital. Thankfully, they are not allowed to engage in the fraudulent practice of fractional reserve banking. They have more than 100% reserves.
Yeah, a lot of them have like $1. A good one will have like $1.07 to $1.10, or even more than $1.10 back in every dollar.
Yep.
That's amazing.
So I'm going to keep reading what he said here, but I think we've already answered it. So he says, let me make this more clear. The cash value belongs to the insurance company. It doesn't belong to you. The properly structured whole life policy bandied about by settlers of infinite banking is really just a life insurance company that is owned by policyholders and pays a dividend. So no, we've talked about that before. Proper policy structure is a lot more than that, right? It's a blend of base premium, term rider, paid up additions, right? There's a lot that goes into it. It's not just making sure you're working with, I guess he's saying a mutual company that pays a dividend. Yeah, you do want to work with a mutual company that pays a dividend, but that has nothing to do with policy structure. That's company selection, which is important. You want to pick the best mutual company you can find that
Or
pays.
fraternal. I mean,
Yeah, that pays the strongest. Right, that pays the strongest dividend. Okay, but policy structure is about the policy itself. It's not about the company, right? How do I structure the policy to get the best cash flow efficiency, right? So he has no idea what policy structure means. He's talking about company selection, which, yeah, okay, that is important, but that's not policy structure. You could take out a policy from one of these great, well-run mutual companies that is not at all designed for infinite banking, where the cash value in your first 2 years will be zero, no matter how much you pay into it, right?
Absolutely.
So, and that might be a great policy depending on what you're trying to do with it, but
Yeah,
that would probably not be ideally structured for infinite banking.
No, if you're buying for death benefit, what do you care about the cash value? You just want the lowest. You're buying death benefit. You want the lowest premium that's going to buy the most death benefit, right?
Yep. Yep. Okay. The only reason they pay a dividend, the interest your cash value, that interest your cash value earns while borrowed out, is because they overcharged you for the life insurance. Here we go again. Here we go again. So
I'm sorry, I got to say it. What a jerk. That's all I'm going to say.
So first of all, let me back up a step. He's wrong again. They pay a dividend, the interest your cash value earns while borrowed out. No, 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 no. Interest and dividends, okay? There's the guaranteed interest rate, and then there's the dividend on top of that. So he's confusing the two, okay? Now, people will loosely refer to the total amount as the dividend, sometimes called the dividend interest rate, okay? But I try to be precise and make distinctions. This guy is confusing. So he's saying they overcharge you for the life insurance, okay? Well, then how are we getting way more out of the policy than what we put into it, Peter, right? He's acting like what's happening is they charge you $100 and then they give you back 50, and that's the dividend. Well, then how am I getting way more in cash value out of the policy than I paid into it in total premium? How is that possible, right?
That is funny. I just want to say that's financial malpractice right there. Just
yeah, it's misleading. It's wrong. It's whatever. It's just it's clearly wrong. And as DeAndre Clayton points out, it is treated as a return of excess premium. That doesn't mean that's what it is. So the IRS, for taxation purposes, treats the dividend as a refund of excess premium, which is why it's tax-free, which is phenomenal. Okay. What is actually going on is the insurance company is a good insurance company, which means when they make their projections at the beginning of the year, they are super conservative. They assume worst case scenario across the board, and they plan for that. Then invariably, when they get to the end of the year, they find out, of course, we did better than projected because we deliberately assumed worst case. And so now we're going to take that excess and we're going to distribute it to our policyholders in the form of a dividend. That's what actually happening. That's why in the later years of a policy, you can get paid a dividend 3 times the amount of premium you're paying in, right? Well, how is it just a refund of an overcharge if I'm getting 3 times more back than what I put in that same year, right? Okay. The math of infinite banking loans also mask a cruel truth. Okay, let me point out, there is no such thing as an infinite banking loan. There are policy loans from insurance carriers, which we use for infinite banking, but infinite banking loan is not a thing. It doesn't exist. Okay. So we are talking about policy loans against a whole life insurance policy with a mutually held insurance company. Okay. And once again, he says math. Well, no, it's about control. I don't see where math enters into it. You're again focused on return on investment, which is irrelevant. This is not an investment vehicle. Okay. Each insurance company is different, so my example is not a match to all properly structured infinite banking examples. It works like this. When you get a loan of your cash value, you pay interest. True. Then he says in all caps, this is an additional funding of your infinite banking account and not revealed in the illustration. Well, I don't know what illustration he's referring to, but it absolutely is included. If you run an illustration with policy loans, the interest you are being charged is absolutely included in the illustration. It's not hidden. It's right there. And you can, again, this guy doesn't know how to run an illustration, doesn't know how a policy loan works, right? You can look up, maybe I'll try and find some. You can look up YouTube channel examples where they're showing you, hey, you take out this policy loan, here's the interest you're being charged. It's all there. And we can set a repayment schedule if we want to, or we cannot set a repayment schedule. So I've run illustrations before that show us taking out policy loans and paying them back and paying interest, or taking out policy loans and not paying them back or paying interest, but the interest that you're being charged is still included. Now, I guess what he's pointing out is that in this vanilla illustration, none of that's included. Well, duh, he's just showing you the vanilla policy. He's not showing you taking out policy loans and paying interest on them. He could, but that wasn't the intention of his video, right? Okay, so yeah, the illustration does include the interest. And when he says additional funding, what does he mean funding? There's no additional funding going on. I assume he's misspeaking, and I assume what he means is that it's an additional cost, right? So when you borrow against your policy with a policy loan, the insurance company charges you interest, right? That's why they make the loan, because to them it's an investment, okay? But you don't have to pay the interest. There are no repayment terms whatsoever. You can accrue the interest indefinitely, okay? You get a dividend, which comes from the insurance carrier, whose profits in part come from policy loans. So you get some of that back anyway in form of a dividend. And that is interest you're paying anyway. So what this all caps illustrates here is that this guy does not understand opportunity cost. He acts like the interest you're being charged on their policy loan is some new cost. Oh no. That is a cost you have regardless. One of these days I'll do a video on opportunity cost, because if you can't understand this concept, it's going to be hard for you to understand the power of the infinite banking concept. The fallacy he's falling into is this. He's saying, if you pay cash for something, you don't pay interest. Not true. Not true. So is the interest that's charged on a policy loan a cost? Sure, it is. But the question, as always, is as compared to what? As compared to what? Okay. If you take out a loan from a bank to finance a purchase, then obviously you're going to pay interest as you pay back that loan. Okay. If you pay cash for that same thing, you're still paying interest. It's called opportunity cost because you gave up the interest you could have earned. Okay. And there are examples online you can find showing that it's assuming the interest rate is the same. It's basically a wash. Whether you finance it with a loan or whether you pay cash, you end up in the same situation. Because on the one hand, you pay interest to the insurance carrier. On the other hand, you give up the interest you could have earned. Now, what's the difference with a policy loan? You take out a policy loan from your insurance policy. Yep, you're still paying interest, but you are also still earning on that same principal balance. So you recover opportunity costs. So whatever you're earning in the policy, it's all gravy, because the interest that's accruing on the policy loan is that's interest you're going to pay anyway, regardless. So he thinks this is like some mind-blowing thing that he's discovered that's been hidden. No, not at all. It shows he doesn't understand opportunity cost. I submit to you that the interest you're being charged on the policy loan, you can effectively discount it to zero. Why? You pay that anyway. No matter how you finance any of your purchases, there is always a cost of capital, always. And when businesses build their financial models, they build in a discount rate, a cost of capital. It's always there. So if you understand opportunity costs, you understand that's a given. You're going to pay that regardless. Okay. So he thinks this is some big dramatic reveal. All it reveals is his own ignorance about opportunity cost. And if he doesn't understand opportunity costs, then I can see why he doesn't get the infinite banking concept. He probably thinks it's about positive arbitrage, which it is not. Okay. Imagine if they would have added these amounts to their sinking fund example. Okay, well, that wouldn't work, because in a sinking fund, in order to spend from your sinking fund, you have to deplete the sinking fund. So you're no longer earning on the funds that you depleted. Okay. Whereas in whole life insurance, when you spend from your whole life insurance policy, you don't deplete it. The full balance keeps earning for you. So yes, it is superior to a sinking fund. Pretty easy to demonstrate that.
I still can't believe this guy's comparing a sinking fund and cash value life insurance. That's stunning to me.
Yeah. Worse, the insurance company may charge 5% while crediting your cash value 3% on the monies borrowed out. Okay, let me stop there.
Here's your arbitrage.
Yeah, even if that were the case, you're still coming out ahead. He doesn't understand this. He's saying, oh no, you're getting negative arbitrage. No, the 5% you're paying on the policy loan is 5% you are paying regardless. It does not matter how you spend your money. You will pay the cost of capital. Go to the bank, take out a loan, pay cash, or borrow against life insurance. That 5% is 5% you are paying regardless, period. Whereas the 3% you're earning is all gravy. That's something you don't get, okay? And by the way, the 5% you're being charged is simple interest. The 3% you're earning is compound interest, okay? So if you're following the discipline of infinite banking, even if you're not, but if you are, you're going to be charged 5% simple interest on an ever decreasing principal balance. Meanwhile, you're earning 3% compound interest on an exponentially increasing principal balance. So you are going to come out ahead, even though it's not about positive arbitrage. Still, you are going to come out ahead because compound interest beats simple interest. Again, he doesn't understand what these numbers mean. He's getting lost in numbers, not understanding what's behind those numbers, okay? There's a big difference between simple interest and compound interest.
Absolutely.
Now, let me add also.
I don't see that anywhere in here, though. This guy should.
Yeah, I know. Somehow you missed that. That subtle concept. He doesn't understand subtle concepts. He's just getting very superficial thinking, right?
Oh, now we're going to get into policy lapses and tax problems. Nice.
But let me ask again. Let me ask you another question. They charge you 5% while crediting you 3%. Okay, so this is not precise. It's not exactly correct, but people will look at that and say, so you're losing 2%. Well, Peter, if you could borrow money at 2% with no repayment terms, pay it back if, when, and how you please, does that sound like a good deal to you?
Sign me up.
I'll take it. I'll take it. By the way, one of the companies I work with, I think the current the interest you earn in the policy is 0.65% less than the dividend you're being paid. So if you can borrow money at 0.65% with no repayment terms, does that sound like a good deal to you, Peter?
Sign me up.
And in that same company has what they call a preferred loan provision. Once you get to year 11 in your policy, the dividend you're being paid and the interest you're being charged are the same. Peter, if you can borrow money at 0% with no repayment terms, does that sound like a good deal to you?
Sign me up.
So no, it's not about arbitrage. It's not what it's about. He's missing the point that that cost of capital is baked into the cake. He does not understand opportunity cost. Okay, so we're reaching the end of our time. We'll go a little further, but
Yeah,
I find it
I got a hard stop at 3.
I find it hilarious that he puts this in all caps. Like, this is just hilarious to me. First of all, that's amateurish, right? You're showing you're not professional, but he thinks this is some like huge reveal when really all he's doing is revealing his own unbelievable ignorance of a very basic financial concept, right? You're being charged interest on a policy loan, and that's not included in the illustration. Well, it's not included in that illustration you cherry picked. That's because that's just a vanilla illustration. It's absolutely included if you show policy loans. And in fact, let me see if I can do this on the fly, or not on the fly. Let me pull up, see if I can do it in time. I have examples where I've shown, people taking out policy loans. And in fact, let me see if I can pull one up right now for retirement income. So I can show you this real quick in the time we have left. So this is an illustration that does show policy loans, and the interest that you're paying is absolutely included in this policy. So the interest you're being charged is included in the loan balance, okay? So what we're doing here is a pretty standard strategy of taking out policy loans in retirement with no intention of repaying them as a form of tax-free retirement income. And this is a pretty standard strategy. So in this one, we've got, roughly $1.5 million in cash value at age 65 and a $2.6 million death benefit. And we're going to start drawing income. So we're drawing $82,000 of tax-free income out of the policy over 20 years. Okay. In here, where it says total loan balance, see how it's growing, and that includes the interest you're being charged. So this loan balance grows. Okay. And that includes the interest you're being charged. Okay. So as this loan balance grows, it includes the interest. It's not, no one's hiding it from you. It's there. Okay. You could even parse it out if you wanted to, and you could see exactly how much of that is the principal and how much of that is interest. Okay. The vanilla illustration that he was showing didn't have any policy loans, so there's no interest to show. No one's hiding anything. Okay. Now, what's the kicker? Peter, we started with 1.5 million in cash value. We drew $82,439 in income for 20 years. So that's 82,439 times 20 equals 1.6 million. So we started with 1.5 million in cash value. We drew 1.6 million in tax-free retirement income with no market risk. And we still have 1.2 million in cash value left over. We started with 1.5 million. We drew 1.6 million out of the policy, and we have 1.2 million left over.
And isn't there a death benefit?
Yeah, this numbers guy can't understand how that works. How do we get 1.6 million out of 1.5 million, and we still have 1.2 million left over? So we started with 1.5 million in cash value. We got 1.6 million in tax-free income, and we have still $1,268,067 in the policy, 2.9 million. So we got roughly double the amount of tax-free cash benefits as cash value that we had in the policy, not to mention the death benefit and the long-term care protection. How did we do that? Because of the policy loan feature, because of our ability to borrow against the policy with no repayment terms without interrupting the growth in the policy. Okay.
And there's the big difference too, is there's no sequence of returns risk here. This is also what people don't get.
Right.
Stock market crash doesn't all of a sudden, blow this policy up.
And the policy loan interest charges are included here. That's including all the policy loan interest that you're paying. You're accruing it, actually. You're not paying it out of pocket, but it is being accrued, and it comes out of the death benefit. And even with all the policy loans we've taken and all the policy loan interest that's been charged over 20 years without us paying a dime back, we still have a residual 1.7 million death benefit. That's net. Your gross death benefit will be much higher, but your net death benefit once all those policy loans are paid off, is 1.7 million. So if you want to show policy loans and the interest that's being charged, you can. It's just the illustration that he cherry picked is just a vanilla illustration that doesn't include any policy loans or policy loan repayments or interest. But we can show it if we want, right?
Yeah.
So once again, he's using a non-infinite banking video to try and attack the infinite banking concept.
It's sad.
Yeah, well, this has been fun. Anything else you want to leave us with in closing, Peter?
I think we've already went over it. I'm just like, it's bad.
Yeah, I need to do a separate video on opportunity cost. That's one that really needs to be addressed, because
I agree.
if you don't understand that, it's hard to grasp the full power of the infinite banking concept, right? So I can understand why this guy is confused and why he thinks it's this big dramatic reveal that you're being charged interest on a policy loan by the insurance carrier. Yeah, everybody knows that. Okay, that's interest you're paying anyway. There's no avoiding that. There's no getting around that.
And what I say about that is, if you were your own loan officer, would you ever deny yourself a loan?
Right. It's the whole element of who has control, right? Infinite banking is about control. It's not about interest rates, right? You now have control of your capital. You now have control of the borrowing terms, right?
Yeah. Were those HELOCs and how about, credit card lines and all that stuff during the Great Recession? Weren't they being cut left and right? They were, right? You're not, if you have cash value life insurance and you want a loan, they're not going to deny you. They can stop your HELOC or whatever else. They can stop it. They're allowed to.
Right. This is what we mean when we say you become your own banker. It's not about maximizing return on investment. No, it's about gaining control of the banking function in your life. Either because we're all engaged in the banking function, whether we think about it or not. And people don't know what the banking function is or what it means. That's another problem. But either somebody else is going to control the banking function and somebody else is going to profit from providing you with the banking function, or you can control the banking function and you can control from the banking you're already doing anyway. That's the question. It's not about return on investment.
Nope. Okay.
All right. Thanks so much for your time, Peter. This is part 2. We'll look forward to the next one.
God bless.
Godspeed.